Although some investors are celebrating impressive returns within a month, I have a different approach, as I believe it's too early to celebrate and there are potential risks to consider. It's not that there isn't a reason for optimism, but too often during a bull run, the other side isn't being emphasized enough. I'm going to do that here. I will present to you why I have started trimming heavily and why I think my cash position will increase even more. I have a contrarian mindset, and even though many investors are thrilled with the impressive gains in their portfolio year to date, I tend to remain cautious and examine the market carefully to identify any potential risks. As a value investor, I don't disregard short-term losses and take them seriously. In fact, I can demonstrate my approach to short-term losses in this video. Let me focus on the macro perspective and explain to you precisely what I mean. I'm not a macro guy, so take this with a grain of salt, and no one can predict the future as no one has a crystal ball. But what we've seen year to date is impressive performance. My portfolio is up since January 1st, and Europe has been on an absolute tear. But most stock markets in the world are also showing impressive numbers. So now we have to ask ourselves, is this justified? In Sweden, for example, we've seen bull rushes like this twice in the past 10 years, once in 2015 and once in 2019. Historicals are useless here because for 1 year, that year ended with a 10% rate of return and the other 35% rate of return. There are no good historical proxies of what might happen here due to overall macro uncertainty we're currently in. But what is driving this? Well, there are many assumptions or reasons that might be driving this. I will showcase four of them, which I think are probable. The current assumption the market seems to be working under is that we've seen inflation reach the heights that it's going to be and that the inflation is going to be declining, perhaps even quickly, to more normal levels in the coming few months. This is a view seem to be gaining most traction among central banks in the West. I believe this assumption to be dangerous and potentially false because if we're looking at core inflation numbers where we account for volatile energy prices, it seems very unlikely that's going to be as quick as that. Now let's move to the second assumption or reason for a market bounce, and that is lower pace in inflation means that many believe we've seen top interest rates. This goes hand in hand with top inflation. The assumption seems to be that most central banks are dying to stop increasing rates, and indeed some national sentiment seems to echo this. And this is despite most central banks actually and clearly flagging for further increases. The joyous bounces in stock market numbers have been despite such messages. It seems to be based on very dovish interpretation of not only the Fed, but of central European banks as well. It is my clear stance that most investors are over-interpreting these results on the market on the positive side, so that this is a positive news, which I think is false. Now, thirdly, there is no European energy crisis. This is one assumption some investors think that is a reason for the bounce back. This one was easy for me to debunk when it actually was spoken about. I never believed there to be any energy crisis in the sense that we would run out of power, nat gas, or resources in the sense that Russian propaganda has been depicting. Examples of this are one from Gazeta, which is a Russian media publishing site, which says, I quote, there are very pessimistic forecasts how Europe will live without Russian gas. Or this one from Ukraine World, the West is freezing, Russia wants others to suffer without its gas. What we've seen, however, is incredible volatility and energy prices increases, which have struck European households to where now over 7% of European households can't pay their energy bills, even in better times, according to Eurostat. And I am from Slovenia originally, and as you can see, we are on 5th place as percentage of households. And also, an ever increasing number of loans are in non-performing loan status, NPLs. So this is stage 2. And currently, based on a report from Intrum, 1 of 3 European households is expecting to miss at least one bill payment in the next 12 months. So we didn't have any Europeans dying of cold in the streets because we have no electricity or gas. But to go ahead and say that the difficulties are over, that's again going a step too far. And also, the war with Russia and Ukraine, it's not over. It's still ongoing and it's not going anywhere as I do not see any quick or expedient way, even if the war ended today. Companies would still stay outside and we would need to see what happens with sanctions and how Russia would have to repair what it has done. I don't think it will be that easy. Now, the last and final assumption we will consider today is China is back in business. Now, obviously, China is doing a 180 on its COVID-19 strategy, and this is also contributing to this. The nation has let go of restrictions and it's opening up again, and many investors are expecting a return to growth normalcy. I don't think that's on the table as positively as people seem to think, and I think China's troubles with its property sector, the current geopolitical situation, and ancillary troubles are still very much there. Now, although I own Tencent, I do not own any other Chinese stocks and I have no plans to do so. Regardless of this, China's economic performance has a significant influence on the overall macro environment and the global stock market, affecting the world at large. Now, what's the problem with what we're seeing? Well, it's essentially doing a 36-hour shift at your job, then taking a massive injection of caffeine and suddenly thinking, oh, this is great. I can do another 36-hour shift. It just doesn't work like that. I can tell you from personal experience. And just because we've seen some signs that the peak inflation has been reached does not equate to the central bank suddenly halting interest rate hikes or that the inflation will drop down as far as fast as we saw it rise. Typically, inflation declines take far longer than rising. That's the reason central banks usually want to be ahead, and that's the reason why communication regarding inflation expectations and cycles is done so carefully. Those in charge, they know that once it's talked about, it's a cycle that can pretty much start feeding of itself. I'm watching core inflation numbers, and from a broader perspective, things have absolutely gone nowhere. This is a figure of KPI inflation between euro and USD macro bond. The blue is the KPI excluding food necessities and energy prices, the corresponding metric. And we're up on a mountain. And even if we drop 1 or even 2% here, we're far from where most central banks want us to be, and that is around 2 or 3%. It's also unclear whether we're really in for a soft landing in terms of economic growth. The economic pressure of the majority of Western world households remains hard, and forecast levels, generally speaking, are very low, which is a real threat against the coming numbers in terms of employment, jobs, and related metrics. The central banks are hoping the job market is going to be cooling off, but the current state here, coupled with inflation, interest rates, and a property sector in trouble in most nations, is really something to watch. Previously, from October to January, I thought the market was excessively bearish and had invested a considerable amount of my savings, even though I had to reserve some of student related expenses since I moved to Switzerland for half a year where I had a student exchange. This decision turned out to be rewarding. However, since mid-January, my attitude toward the macro environment has shifted and I have become more reserved. Now remember, we're in mid-earnings season, and not just any season, but companies are posting their annuals. It's relatively typical, historically speaking, that a bullish run will be intensified by a number of companies beating expectations, and we've seen that across not just one, but multiple sectors, as well as from many companies. And let's remember that it's not unusual for companies to beat estimates, because most estimates, especially now, are set lower than the Mariana Trench. And let's also hope that companies don't become too overconfident and start estimating negative earnings just so they can outperform again. To say that the companies are doing well or because that there are some signals that things are perhaps cooling down, that things are suddenly fine, is false equivalency. It's a real problem and it's what I see on the market today. Now, let me be clear. I don't think 2023 will necessarily be a repeat of 2022. I think overall we're in for some recovery unless things really turn sour somewhere along the line. However, this sort of massive push that has seen some parts of my portfolio and some sectors up nearly 23% in a single month, that just odd. And to me, it's very good example of market overreaction in the opposite way. So, the $1 million question, how do we handle this? Well, I can tell you how I'm handling this. And I am trimming. Yeah, that is correct. I don't usually do this, but this time I'm actually harvesting profits with the precision of a bonsai gardener. I'm talking about companies that might have gone too quickly or companies where much of the original upside has really been seen in the short term. So examples, Allianz or Munich Re, which I spoken about last year. And although they haven't risen as fast as some tech companies, if you look at the graph now, you can see that the stock price has outperformed insanely. But the valuation history here is very clear. Both of them have trouble rising above the levels we've been trading here, and being that I'm up extremely on both, this is where I start harvesting profits. Every position needs to justify its existence in my portfolio. I want an upside, I want a good yield, good safety, and good forecast. I don't want companies where a bullish thesis is based on flat growth for the next 2 to 3 years, along with a 3 to 4% dividend. That's not good enough. I'm an active value investor and I'm not tied to any of my investments. Sure, if I sell in less than 5 years or 20 years, I will have a considerably higher tax rate, but still, I'll kill a position if my math says I should and push that capital to work elsewhere. There are literally hundreds of qualitative dividend paying conservative businesses in the Western world. Hundreds. And I cover a fair share of them in many sectors. That's one reason I was so confident in not investing in tech when it was in a bubble, and it's the reason I'm so heavily invested in the communication sector at this time. It was the reason I was able to forecast European outperformance and financial outperformance a year ago. I've made mistakes along the way, of course, ignoring sectors that I shouldn't have ignored. Looking at you, energy sector, the clearest miscalculation was not going to oil, and of course, energy when the sector was down in dumps. This is a mistake I don't mean to repeat for any sector, regardless of what sector it is, even if it's growth tech. My short career as an analyst has taught me, alongside my investment history and performance, that spotting undervaluation in a sector or a market is entirely possible. So is spotting overvaluation or a dangerous set of trends such as the ones we're currently in. I'm not saying I'm ceasing to invest, but I'm extremely picky where I put my capital to work at this point. I'm still harvesting into some REITs on which I'll make a video. Specifically, I'll publish a video with 3 REITs that are potentially good to invest in currently. There is a chance I'm trimming my positions too early and that the bull run will extend to March or April, but I don't believe it will. I believe we're in for a contrarian shock to the downside. Now, wrapping up, the macro level valuation trends I follow in literally the hundreds of companies has taught me one thing. Valuations are too high for where North America, Europe, and Asia are currently in terms of inflation, interest rates, and macro. And this requires a correction, as I see it. A correction will come, and out of hundreds of aforementioned companies, less than 45 are now truly investable. That's the first time in over 6 months that this has been the case. A month ago, I would have told you to throw a handful of cash at the stock market and you'll likely hit undervalued equity. Now I say you need to approach investments with more precision to secure good returns. I will try to do my best to inform you of my approach to these changes. I will highlight companies, be as clear as possible about trimming and cutting, and answer questions and queries to the best of my ability. Personally, I think this is the time to stay safe, to stay higher in cash, and not go crazy and file the masses which are investing in anything that has risen in the past month. So that's all. I hope you enjoyed the video. If you have any questions, leave them below. And that is all. See you next time.